Joining us right now for a look at where the markets could be going on this news is Ryan Detrick. He's senior market strategist at LPL Financial. And Ryan, you say this volatility was overdue, but have we seen the end of it yet?
Hey, Becky, thank you. Glad to be back. No, we don't think so, right? I was on 2 weeks ago with Joe. We talked about how be on the lookout for volatility. Think of it like this. We just went the longest time since 1955 without the S&P dropping 2 days in a row. Over 3 months without so much as a 1% move up or down. Now, after last week, we had 3 1% moves. We think, as we get into the historically troublesome month of February, we wouldn't be shocked at all if this pullback and volatility continued. I know we're all blaming it on the coronavirus, as deadly and as devastating as it is, but we think the market was ready for some volatility. That's just taking the headlines, and it's probably here to stay for a little bit.
We had Mohamed El-Erian on just about 45 minutes ago. He said, look, at this point, he thinks this is different than any of the other things we've experienced to date, any of the concerns, whether it be the trade war, whether it be what happened with Iran earlier this year. He said this is the one thing that he would say, OK, time to step back and take a pause. What do you think?
Yeah, I mean, we wouldn't disagree totally with that, right? It's the uncertainty. It's kind of that sell first, ask questions later mentality. But at the end of the day, when we look at all these pandemics and epidemics, the bottom line is if the economy stays strong, which in the U.S. it still is. I mean, it really still is. We could have a little more of a pullback, but honestly, we're sticking with the cyclicals. We still think that's the area that brought us to the party, and we would use that as a buying opportunity because we just simply do not see a recession happening in 2020.
Let me expand on what Mohamed said. His concern is that the central banks around the globe will step in to try and help things. We've already seen that happening with China, and the expectation from investors here in the United States is that the U.S. Fed will also do that, too. I think expectations are now for 2 cuts this year. His point is that this could be different. This may be the time when we learn that central banks can't fix everything.
Well, what are the 4 most dangerous words, right? This time is different. And we don't truly know that, but you're right. I mean, just a couple months ago, no one expected the Fed to cut. Now it is pricing into the short end of the curve once again is inverting. But again, when we look at earnings, we look at different things. I know all those concerns. We're not naive to those. But we still see an economy that can grow at 2%. Earnings this year can grow at 7 or 8%. That can withstand a lot of potential negatives that we see overseas.
Ryan, it's Michelle. If the coronavirus weren't happening, we'd likely be talking about what's going on in Iowa and the rise of Bernie Sanders in the polls. Do you think that's going to have an increasing impact on the averages as we move forward here?
Yeah, very well could. We've seen some of those charts where Bernie Sanders' percentages go up. It potentially can hurt yields a little bit. But, we also might be talking about the Super Bowl more, right? I mean, congrats to the Chiefs last night. But clearly, Corona is what's taken over. That's what we're focused on. Markets tend to focus on these things. But absolutely, as we go more into the election, the bottom line is, we're going to focus on that. And don't forget, the stock market, when you have a president up for re-election, has not been down since 1940. I know 2000, 2008, the markets went down election years. Those are lame duck presidents. Bottom line, historically, markets tend to do well when a president's up for re-election. That's something you should not ignore in 2020.
Ryan, aside from the cyclicals, can you be more specific with things that you really like here?
Absolutely. Yeah, we still like the financials. We really like the industrials with some positive news on trade like we've seen recently. We like tech as well. We're equal weight tech. We know tech was up 50% last year, but look at earnings this year. I mean, tech has had really well earnings. And I'll tell you what, emerging markets, I'm fully aware of what's happened in the last week or so. We really think we're going to avoid a global recession, and emerging markets are very cheap. 14% earnings growth in emerging markets, double what we should see in the U.S. this year. That's an area we're starting to dip our toe, and this pullback, it looks a little tasty for EM as well.